Welcome to the Ty and Rye the Finance Guys podcast, covering weekly investment news, important financial topics, and expert interviews. We want to help you become more knowledgeable about the financial world around you. This is not an offer to sell you anything, and remember, past performance doesn't indicate future results. Now your hosts, Ty Hansen and Ryan Robertson.
Hello, and welcome to the Ty and Rye the Finance Guys podcast. I'm back, Ty. I was absent last week.
Welcome back, brother. I'm glad you're back. It wasn't the same with just me.
Yeah. Well, you know.
The people have spoken, and they basically said, "You're okay solo, but you're excellent with Ryan." So I'm glad you're back.
And Ty is coming to us from his barn. Mm-hmm. If you hear some horses whinny or some cows moo, just Ty's farm animals.
Okay, for the record, everybody, we are moving offices. Our North Utah office, our Lehigh office, we're moving offices, and they're painting / ripping up flooring. So I wasn't able to have all my stuff, my camcorder and my camcorder. That's not even a thing. My high def camera and my microphone, all that stuff. Don't have any of it. So yeah. we're here at my little mini home office, and I have these beautiful wood slats behind me to give us the barn effect. So
very primitive. It's very primitive this week.
Hey, you know what? We're in our roots. We're back to our roots. We're very, down to earth. We're gonna just, shoot it straight. So
yep, and that fits right in with what we're gonna talk about: insurance. I guess somehow that fits.
Yeah, nothing shoots straighter than insurance. So no, I'm really glad we're diving into this one because so it's funny because my first real true exposure in the financial industry came from more of an insurance world. My oldest brother actually sold me a policy when I was like 17 or 18.
Perfect.
And in fact, it's funny because I actually still have kind of like a different iteration of that same policy, but insurance is really, it's out there. And I think a lot of the quote unquote advisors will sell insurance products. And there's a lot of crap built into there. So I'm glad we're diving into this today.
Mm-hmm. Yep. There's a lot of mix and matching with it, and a lot of selling you one thing for another purpose when it may not actually fit for that.
Yep. Exactly. So
well, yeah. So we're gonna go through just sort of a heads up. We're gonna talk about the different types of insurance, and again, we're talking about life insurance. We're not talking about auto insurance or
Geico
or health insurance
or health
or home insurance.
Oh, seriously, health insurance is like, oh my gosh, we could spend 10 different episodes on health insurance, and we don't deal in health insurance for exactly that reason. It is the biggest pain in the butt, and there's so many crazy moving pieces.
So we're talking
life,
only around life insurance. So
yep.
The different types, essentially, we were talking earlier, there's two types. There's basically term insurance and permanent insurance, right?
Right.
Describe those, Ty. Both of them.
Very straightforward. Term, a finite period of time. 5 years, 10 years, 20 years. Term. Permanent, it's the entirety of your, in fact, people will call it whole life, for your whole life. But yeah, permanent is, that's what it is. You will have life insurance until the day you die, no matter what.
And it's an easy,
as long as you're paying your premium.
Yeah. And you can kind of tell too. I mean, obviously they'll have a term, how long it goes, but premiums between the two, what you pay every month for the insurance is definitely significantly different. So you'll kind of know that as well. So just real quick with term, it's the simplest one. There's not a lot of variations on it. Essentially, what do you get if you got term insurance?
Yeah. In fact, I'll dive in a little bit to like my own personal life insurance setup, and just like with everything else we talk about, right? There's never like one exact fit for everybody, right?
Yeah,
and so it's kind of understanding what's the best for each situation. So just because of the way I have mine structured doesn't mean everybody else should. So like the lion's share of my life insurance coverage is through term, right? In fact, and I've actually built two. No, I actually have three. So I have three term policies. One is with in our business, right? So if I pass away, it helps you and the business keep running, right?
With your
if I fall off a cliff, I get stuck in an avalanche.
You get impaled by a sharp rock at the bottom. Mm-hmm. Right.
If you get sick of me and somehow my brakes get cut, I don't know, right? Something crazy could happen, right?
Something could.
That's a term policy. I have so personally though, I have two policies that are staggered. And all in all, I have about $1.25 million, $1.5 million coverage, right? And we'll talk about that in a second. How much coverage should you have? We'll talk about that in a little bit. But I have it staggered for two because those again, and each of mine are 20-year chunks. I have it so that they kind of overlap, so that eventually one's going to fade away and I'll have less coverage. But the idea with term is, again, it's a lot less. So basically, almost $1 million of my coverage comes from term, and like the total cost for me for all that term is like $25.
Right.
It's really, really crazy cheap. Again, because I started both those policies when I was, the one policy I started like late 20s, early 30s, and I've just I've always been lucky. I've got good genetics, good health. I run, all those things. So term's really cheap, right? Term is going to be a lot less expensive because it's a finite period of time. Right. Term can convert. A lot of times they'll have a conversion piece. In fact, part of my so I've got about an 80-20 mix. Part of my permanent insurance was an old term policy that I ended up converting into a permanent piece. Yeah. So my term is cheap, and the idea with term is like a planning, like from a financial planning standpoint, is you start it when you're younger, and then as you slowly build up assets throughout your life, you now have enough assets that replace what you needed for term, right? And that's my whole point. Like that's what I'm doing with mine is I'm slowly building up my net worth while I'm working, right? If I die before I reach, that nest egg for my wife and for my family, then that term will pay out if I die and take care of that. So that's right. Term. The permanent is going to be a lot more expensive because they're guaranteeing that you'll be covered for the rest of your life. So
yeah,
again, cost is a big difference in timing. That's really what it comes down to. So.
Right, because obviously with term insurance, it may go away before you die. So that's why they don't have to cover you if that term insurance fades away.
Yep.
Right. Whereas with the permanent,
yeah. So like for example,
it's always there.
Yep. Yeah. Like I think the two policies I have, like I said, like one I started around 31, 32. So it's a 20-year term. So in early 50s, that's going to go away for me. And if I die, say at 55, the insurance piece is going to pay out a lot less to my wife. Because that term policy is expired. So
right.
Yep. And then obviously the cost of any insurance is going to be based on how healthy you are, right? What your mortality looks like. Because actuaries are smart enough to know, okay, you're this age, you're male or female, this is what your occupation is, this is your education. Statistically, this is how likely you are to die, right? So they know all that mortality data. So trying to get a term policy when you're 65 can be really expensive. A term policy when you're 35 is really cheap. So
right, and we should pause just real quickly. Say there are a couple of variations on term policies. One could just be a no medical test, right? It's basically accidental death insurance, which would be cheap. You can still get it for pretty cheap. And then there would be a different type where you're getting an actual. They draw your blood. They send that in for, some type of medical. And again, if you're healthy, you're just going to get better premiums. So, there's a couple.
Here's the interesting thing with that too. I'm glad you bring that up. That's a good point because just for everybody listening, just so you know, like you can go back and actually check with whoever does your insurance who helps you with insurance, right? Selfish plug, we do it too. But a lot of insurance carriers now have actually changed their underwriting standards. And so, like, in fact, the policy that we put into place for the business, right, the Keyman insurance that we put into place, I actually didn't have any medical. Because basically it's like, okay, hey, if you're, I think it's like 60 or younger, if you're this age, if you're these things, they actually don't require it because medical data is now so centralized that they know based on your credit score, age, where you live, your medical history, they know if you're good to go. So like I had, like the highest rating for our key man policy that I have on me for our business. And I didn't do a single thing. And it literally took like a day. Like they called me up and then within 24 hours I was approved. So, there's a lot of ways to cut those costs. There's ways to make it easier to get underwritten, things like that. So,
yeah. So you can pay less and get more coverage in a term is generally the idea.
Yep.
So, and then it kind of gets you to the other side of it, which is, okay, now we're talking about these whole life policies where it's permanent. It's going to be for the rest of your life if you keep the premiums up. Now there's a lot more variations in that. It's a little bit more complex.
Oh yeah.
So I
think
very,
very crazy.
I think the biggest question too when you talk about that is why then do permanent, or what is the advantage of doing a permanent policy?
Yeah, good point.
Thanks, Ty.
Nice job, dude. Way to keep this ball rolling. So the idea again, remember, there's just a basic pure whole life. That's it. Like, the exact premium day one, it's going to be the premium for the rest of your life. Obviously, the advantage is just knowing that you've got that chunk of change forever, right? So if you die at 50 or at 99, you're going to get the same payout no matter what, as long as you make those premiums. It tends to be a little more expensive, right? Because it's like that insurance company's taking a much bigger risk because they know for sure they have to pay out on your policy. They know for sure.
Right.
So, let's go back in time, late 70s, early 80s. They also kind of tweaked it to make a hybrid of the two. And that's where we started to see this universal whole life. What universal says is, okay, look, we know that you're going to be less expensive to insure younger, so we're going to make your premium low. But as you get older, that premium is going to go up. Now, the nice thing with it, though, is we know that, okay, so if Ryan's really healthy at, say, age 35 and he starts a universal life policy, which, again, is going to be permanent as long as you're paying the insurance premium. If you get cancer at, say, 61, that doesn't affect your premium at all. It won't affect your premium. Your premium will technically still go up, but it's not impacted by any health changes. It's only based off of when your policy started and the general escalation data, right?
Yeah.
So, but I want to dive into the details of that because this is the part of the insurance world that's really saturated, and we'll dive into all the ways that people use life insurance for investing purposes. And it's the least. So, dude, I've been in this business for a long time. I feel like I know how things work in this business. And it is the most confusing, like you get in this like turnaround, like it's crazy how these policies work and what the charges are. And so it just gets messy, right? But again, as long as you're funding it right, and typically people will have extra money put in there. They have a little bit of cash. And the idea is that cash over time will help pay part of the premium to keep it low. So it's subsidizing itself. So that's kind of this universal world is kind of this mismatch of the two to keep premiums somewhat low, but also give you something that's permanent in nature. And so I have a version of that, right? I have about 25% of my insurance coverage is through indexed universal, right? Meaning there's some investing pieces to it behind the scenes that it's growing.
So let's just ask about that because I think it's going to get confusing. The idea of permanent insurance is that the insurance lasts forever, but it has a component that you can put more money in above the premium, right?
Yep.
And the amount that is above the premium goes where and does what?
So it goes into a cash account.
Okay.
And that cash account can be invested, right? And
they call it a cash value, right? Essentially, if you're looking at a statement, call it cash value.
Yep, your cash value.
That's the excess that you have put into it. And there's only so much you can put. You can't put as much as you want into that, right? They call it a modified endowment fund, right?
Yeah, exactly. You can technically cram a ton in there, and we call it a MEC, modified endowment contract. it just changes the taxation of it, because then what the IRS is, hey, you no longer have, you're not doing this for insurance purposes, you're doing it for investing purposes. So we won't dive into those details, but actually sometimes turning an insurance policy into a MEC is actually not a bad thing. It's actually a pretty cool strategy you can do.
Yeah.
But yeah, you're right. So there's kind of this window of, if I'm putting in so much, I'm building up more cash. The cash is also growing in the markets, with the hopes that will pay part of my premium as I get older, when those premiums go up, right? Subsidize.
Right.
And yeah, they're invested.
Cash value can be used to pay for the premium.
Yep. And so, and I don't know if we're ready to dive into it just yet, but this is the key nugget that I really want to dive into, right? This is the piece of insurance that a lot of people don't get. And they think, oh, I've got this cool investment in this life insurance. Yeah, you do, because your money's being invested either in the stock market or in bonds or whatever. But in my opinion, it's like, I always want to get an investment as in its purest form, the least expensive form, with as few layers as possible. So yes, you're technically investing with that cash value in your life insurance policy, right? It's got the insurance umbrella, but it's got layers to it. Versus you put money in Robinhood, there are no layers to it, right? And just think about it this way: every time you're adding a layer, an insurance agent, an insurance company, permanent insurance coverage, all these other pieces, that costs you money.
Yeah.
Right. So, and the other thing too is, people get all excited. They're like, oh, I've got 50,000 built into my cash value. This is awesome. I'm going to pull a bunch of that out. You don't know this, but that cash value, you might need all of that to subsidize your increased premiums when you're 65, 70, 80, right? That's the problem, is as you get older and those premiums start to go up, guess what? If you don't have the money in there to subsidize, I mean, you're talking, your premium might go to 3,000, 4,000, 5,000 a month, right? And now you're like, well, crap, I've put all this money in this thing for 25, 30 years, and now it's useless. So this is where, again, yeah, you're using it for investing, but so, and I'll be straightforward on this podcast. I am going to be very biased in this, because I do have a very strong opinion about insurance. Insurance is awesome. It's a really fundamental and key tool. But again, all things equal, if I have $1 to invest, I don't want to put that dollar into a life insurance policy, because I'm going to lose, I don't know, let's call it 25 cents of every dollar for insurance purposes.
Right.
Versus if I go buy the same coverage amount in term, and that costs me 10 cents for the dollar, and I take my other 90 cents and I go put it in just a regular account, what's growing? What's going to grow over time the best? Yep. More money in the account, right?
Exactly.
The term / yes, exactly.
Okay, can we real quick, let's take a step back just to make sure that we're clear and understanding what we're talking about. So,
yeah.
Because in the idea of the permanent insurance, it's almost like the money you're paying for your premium, right? Premium being the monthly payment. There's two buckets that money is going into. One bucket is to pay for the actual death benefit that you would get in the event of your death, right? Second bucket that money goes into is it's going to move into your actual, almost like a savings account. It's like a backup savings account, right? Now, that money in that savings account, according to the type of insurance policy you get, could be used for some sort of investment purpose.
Right.
Okay. So the point that you're making then is, or maybe the mistake that gets made, or the overreaching that gets made is, it's an investment. This is an actual investment strategy.
Yep.
Right?
Yep. Exactly.
And we both have seen this happen. I remember 15 years ago being pitched on these ideas.
Yep.
Overfunded, and it becomes this amazing investment tool.
Yeah. Well, and here's the thing too: is it does have a lot of similarities to a Roth, right? Because remember, I talked about Roth last week. where you put the money in and it can be, reinvested, switched around, no taxation, yada, yada, yada. Right.
Right.
And you can, a lot of people will talk, we'll talk about this infinite banking idea. This is an idea that's built into these policies. Well, you can just take a loan out and,
buy
no big deal, and you don't get any taxes, and buy a car. Yeah. Do whatever.
Pay yourself back.
Self-finance your own stuff. Mm-hmm. Yep. And this idea is like, well, then you don't pay taxes. It's just like a Roth. Yeah. There are some definite tax benefits that you can do it this way, but you hit the nail on the head, and you totally described it perfectly. There are these two buckets, right? I never in a million years ever want to invest my money in anything that I can't fully understand what the hell is going on. If I don't know what's going on, because again, by nature, I'm just an OCD guy. I want to know all these details. That bucket, again, having done this for as long as I've done this, I can look at these buckets, the life insurance bucket and the cash savings bucket for people. I can look at their contracts. I can look at their insurance carriers. I can't tell you everything that's going on inside those buckets.
Yeah,
I can't. And the different ways that they charge fees and the cost of insurance, and there's these, I've even seen some weird fees for once you're over 60. Again, does it mean insurance is bad? No, these are really good tools. They're powerful tools. We use them for clients. But when you're thinking, I'm putting all my investments, I'm doing this really cool thing to get this Roth savings, it's like, okay, yeah, you're getting some cool tax savings, but you're giving up 30 cents on the dollar to get those tax savings. So what's the net effect for you? That bucket that you just talked about is the key to all this thing. What the hell is going on inside that bucket?
Yeah.
So,
well, you made the comment earlier, and we can kind of maybe go into that and start talking about this, which is there are investment accounts and there are insurance accounts. When you start to cross those over, right, try to make an insurance product an investment, right, it starts to become somewhat of an issue. And so talk about that infinite banking. And why, may or may not make sense.
Yeah. So, in fact, I'll kind of use my own, permanent insurance piece to kind of explain all this. Because in fact, it's funny. I'm in a very small way, I kind of use the infinite banking strategy, even though we'll talk about kind of the do's and don'ts of using overfunding life insurance.
Right.
So again, I've got this about 20%, I've got about 200,000 or 300,000, 400,000 of my life insurance coverage is in an IUL. It's part of an IUL. It's a policy I've had since I was early 20s. So my cost of insurance is insanely cheap. And so because of that, and then two, I obviously manage the way the monies are invested in that thing, and it does really well. The other thing too, just a quick clarification. Variable life insurance means that you get more upswing in the market, but if the markets go down, you capture all that downswing too.
Right.
Typically, an index universal life (IUL), it matches an index, and they usually have like a floor at 0%. You're going to lose part of the upswing, but you're also limiting the downswing. So I've had this money invested. It's grown. It's exceeded what amount I need in there. So you can actually run calculations at any time with your insurance carrier and say, hey, how much do I actually really need in this thing, project it out so that how much cash do I actually need in there to support this? Yeah. And so I watch that, and over the years, I pull my excess cash value out because I've done well with the investments, right? So I pull the excess cash out as a partial surrender, partial withdrawal, pay a little bit of tax on it, which I don't care. And then I go use that money elsewhere, right? Again, the idea with this is that my cost of insurance is so cheap, I don't mind doing this. And I know how much money I can take out of that without blowing up the actual insurance coverage.
Right.
So again, we're gonna get to this infinite banking and really dive into the problem with it. But that's really what it is you're if you're putting a ton of money into this and it is growing, you're using yourself as a bank. And you're drawing monies out of the insurance account without paying any taxes because it's quote unquote a loan, right? And you're paying yourself back, but it's like, again, the key problem with all of this overfunding and this cash value, be it infinite banking or whatever you're trying to do with your life insurance, it's the cost of the dollar in the account, right? And that's what I'm saying. So it's like, well, guess what? If if I've got my money sitting in a Robinhood account and it's growing, and I go to pull that money out, yeah, I'm going to pay a little bit in taxes, but there's no other cost to that, right? So maybe I pay an extra 10 or 15% in taxes. Well, guess what? In your life insurance cash value bucket that you're infinite banking with, you might be paying 30 or 40% in costs of insurance. You know what I'm saying? So
no, I don't actually.
That's the way it.
Explain that.
How so? Where are we off?
Explain that.
Again,
cost of insurance.
It's that cost of insurance. That's what it's simply put. It's what is it costing me to be insured every year? Obviously, the way mine works really well is because I started it when I was 25. I was like the cheapest, like pennies, fractions of pennies on a dollar.
Oh, you're just saying
my life insurance.
You're saying that if you start it later and the premium is X amount, you got to keep that premium going. That's what you're meaning with cost of the insurance.
And it goes up over time for everybody, no matter how healthy you are.
Mm-hmm.
So somebody that's trying to do infinite banking that's 55 versus somebody trying to do infinite banking when you're 35, there's going to be a very big difference in there in what it costs you.
Right. Yeah.
And here's the other piece to this too. A lot of times, if you overfund life insurance, you can still pull a loan out against it, but you can't just take your cash purely out of that account, or you're hit with surrender charges.
Right.
Big surrender charges. And the reason for that is typically because there's a big commission that goes along when somebody sells that policy.
Sure.
Right?
Yeah.
And that's the problem is it's like, so what does it truly cost you to go open up a Robinhood account? Zero. Right? Put the money in there and let it grow. What does it cost you to do a life insurance policy? Well, it looks like zero, but there's these surrender charges, and then this bucket that you'll look over your statement every year, and you're going to see a whole bunch of random fees in there, crazy named fees that I can't even tell you all of them.
Right, I got what you're saying.
That's where you're paying the pipers, right?
Yeah. It's the management that the insurance company has to charge to basically run the thing.
Well, yeah, and it's like, I mean, it's the management, it's the investing, it's just a pure cost of insurance is how much am I actually paying from every dollar to make sure that I have a life insurance piece that the death benefit. So when I die, I get paid. The death benefit piece gets more expensive remember, permanent life insurance. You have one fixed cost, you're set for life. You're going to pay $400 a month for the rest of your life, no matter what. You know what you're getting.
Yeah. But
it's really expensive. It's going to be a lot more expensive than this universal world is in between. Start low and build up.
Right.
So even if you're the healthiest person ever, you can be 60, 70, 80 years old, and all of a sudden that premium amount, maybe when you were 40, maybe the premium was like $300 a year. But now when you're 80, even though you're still technically based off of a healthy person from when you started, your premium might be $7,000 or $8,000 a year, $9,000 a year, $10,000. Again, it's variable. Nobody knows. And there's additional insurance costs that get added into that. And that's right. What you just can't, you can't tell hide nor hair what's going on.
Yeah, you're saying there's a lot of strings attached to this insurance product to get the benefits of it. Right. Okay, that makes more sense.
Yep.
I understand what you're saying.
Yep, exactly. Now, here's an interesting thing. I'll just, as a random side note. So why I keep more permanent insurance. Why I have, like, again, I'm talking about all the pitfalls of these universal life insurance policies. They're not bad. They can actually be really good. And having some permanent insurance is pretty cool. Like, I love the fact that no matter what happens when I die, there's this chunk that's always going to be there. Now, again, my idea is that over time, I'm adding more to just my general net worth. So I don't really need the greatest thing a client can do is never need life insurance once you get older, because you've saved enough money, right? If you've done it right throughout years. Well, what I'm actually going to do with part of mine is I have part of it earmarked that it doesn't actually go to my family. Part of mine actually goes...
because you don't love your family, or?
Mostly. Like, some days I don't really like my kids, and that's why.
Makes sense.
I don't want it to go to them. I want it to go to your family because I just like your family better. Your boys. You actually have boys. I have no boys, I want that to happen. No, it's... So one of the most important things to me was my education. Loved my education at the U. And so a few $100,000 of that life insurance, I've already got it built in to go to an endowment. And that endowment is my wife and daughters are gonna run that. And the whole point is that it will fund some scholarships up at the University of Utah, right? And that's because to me that was so important. I want to pass that. It's a legacy, right? I want to pass that on to some other students. And I would, again, the idea is that as I'm building up over the next few years, if I die today, most likely my family's not going to use that endowment, right? Because they'll probably need the money. But 20 years from now, I'm very hopeful they won't need that money. And so that's where the idea is that, okay, what better thing for them to do than just have $200,000? I'd rather them say, no, go do something really good with this money in my name because it was so important to me, right? So there's some cool strategies that you can do with this. And by the way, that has some pretty cool tax benefits to it too, right?
Right, yeah.
So there's some cool stuff you can do with permanent life insurance that has to do with your estate and your legacy. But again, this idea of I'm going to take all of my money rather than putting it into an investment account, I'm going to put it into this life insurance because it has Roth type benefits or because I can do this infinite banking thing. The cost per dollar going in is some of the most expensive costs you can incur in the industry.
Yeah.
So,
well, that's a really good point because I think that what gets sold to people often are these, I call like patchwork strategies, right? They're taking something that is generally used for, say, in this case, insurance, and they're repurposing it for something else. And there's a lot of bells and whistles that are sold on that. And I just have known a lot of people who have been sold these types of products for all the wrong reasons. And I've also seen people completely lose their policies because of how they did this, how they took their money out and what happened to that money. They lost their policy. So all the money that they put into it, stuffed into it for the premiums, just gone. There's nothing they could really do. And it's really important that as you put some sort of strategy together for insurance, don't get sold a product. Make sure you're getting a strategy with what you're getting. Right.
And remember, the idea here is like we don't, and this isn't a selfish plug for what we do, but we're an ongoing relationship with people. And so, had I sold these products, like again, that recap, if I had sold these products for the last 10 years and that was all I did and overfunded it, I wouldn't have many ongoing clients. You know what I mean? And so again, there's good people out there that sell them the right way, and that's good. There is definitely a good use for this. But if somebody's trying to say, hey, I'll overfund this thing, use it just for this bank, it's like it's expensive, and the real purpose of the life insurance is not really being used the right way. So
yeah. It's just kind of like, whatever, if you're putting together a collage of pictures, right? You just don't want one picture, you want different pictures.
Wow.
Yeah.
See, I don't know.
Gotta
maybe
fit
like put a collage together, just all Ryan, like a collage of just different Ryan pictures.
Yeah, it's like when they do a picture and you look close and it's just little teeny pictures, right? But if you step back, it's one big. It's got to fit in there. Yeah. It's got to fit into the thing.
Yeah. So got to make the big picture's got to look pretty from all the little tiny pictures. Yeah. I like that. Like they did of Kobe Bryant the other day.
There you go. See? Yeah. Make sure it fits in.
Birthday. Yep.
Do you want to talk about annuities right now, or you got something else on this life insurance part?
No, I think hopefully we've kind of helped people understand the different types of insurance. Again, remember term, permanent, UL, universal. So the universal life's kind of that middle range. These are all things that you're doing through an insurance company, right?
Yeah.
Annuities are another way to invest through an insurance company, but it's not for life insurance purposes. And we're going to talk about that in a week or two in another podcast. We're going to dive in deeper to the value, because annuities can be really, really powerful in your plan. Again, different pictures, right?
Right. Yep.
This looks a lot like life insurance, but again, this is an annuity is more on the investment end of the spectrum, not the life insurance end of the spectrum.
Right.
So we'll talk about those. But no, hopefully, I think people have a better idea. If anything, the only thing you take away from this is why are you funding your life insurance, and what is the purpose of that? And if you're overfunding, why?
Yeah.
That's the question. Ask yourself why.
Yep. Yep. And as we talk about annuities, it's a whole different subject, or at least not a whole different subject, but it's a subject that we need to spend a lot more time and go into more depth with. And it is one of those things where, again, as you look at your overall financial picture, your collage, where does it fit in, and why does it fit in? Those are important questions for you to ask. And if your person you're working with can't answer that effectively, outside of how it connects, in other words, how it connects to retirement and family and all that, that's a good question to be able to go, okay, well, why would I do this then? If it doesn't help support these other parts.
Exactly.
So, anything you want to say about annuities? Give it a little tidbit.
Okay, the teaser for the annuities. The teaser.
Yeah.
The thing I love the most about the annuity, it's all about cash. When it comes to building a retirement plan, cash is paramount.
Yeah.
And the way you can build, I would say that you can build a cash flow with an annuity that is more efficient than owning real estate.
Ooh.
Now,
did you see my eyebrows right there? Did you see my eyebrows?
I still love real estate.
Oh, okay.
I love real estate. Real estate is one of my most favorite things in the whole world, and I love it when a client has it in their portfolio. The annuity can be just as efficient, if not more, than that property.
Watch my eyebrows.
And we can tell you how.
Wow. Exactly. See?
I have big old bushy eyebrows.
That's a
good thing these people
really
are listening and not watching.
great teaser.
Don't check us out on YouTube.
No, you don't want to see Ty's barn.
You don't want to see my big old eyebrows.
Well, okay. I think that's good then.
On that note.
I think we'll leave on Ty's eyebrows and annuities. Next time, I think we're going to get into annuities.
Cash.
Yep. We're going to talk about that. We still haven't done the ETF thing. Yep. We got to work on that. That's the next step too. We got to talk about ETFs as well and put our little
bracket.
It may become a reality TV show. You never know. It might.
The ETF challenge with Ty and Rye, the finance guys.
Yep. Just do it for a week. So.
Yeah.
But yeah, so for everybody, tyandrye.com. Go to that website. You'll see all of our episodes on there and links to different platforms that you can subscribe. And some of you have been sending us questions.
Enjoy this.
Or wanting to meet. So if you got questions or you have comments, feel free to leave them. Even if they're not completely nice. If you don't like Ty's bushy eyebrows, it's fine. You can comment on them. Just don't be too mean.
My favorite is on our Instagram page, Ty and Rye on the Instagram page. The random Middle Eastern and European random followers that we get. Where there's these women, they're like, "Hey, smart guy, you and I talk." Like, even if you leave those kinds of comments, we're fine with that too. I mean, it's all good.
Ty,
whatever.
Ty, don't fall for it.
Yeah,
they don't want investing advice. I did
give them our business banking account information. If you're okay with that, I may or may not have saved a Persian prince from prison.
Well, that's good. You're doing your good deed for the day. So that's good to know.
There you go.
Yeah. All right. Well, good.
Hey, I'm in my barn. I'm doing good deeds. Yeah. We're having fun.
Way to go, Ty.
Be kind to everyone.
Yeah. So everybody go ahead, follow us, send us comments. Ty, thanks for your time, man. Hopefully you get out of your barn soon and we can talk in your normal office.
Thanks, bud.
Thanks, Ty. We'll see you next week.
For real. See you, bud.
Hey, thanks for listening to the Ty and Rye, the Finance Guys podcast today. If you liked what you heard, go ahead and hit subscribe. That way you won't miss any future episodes. Also, follow us on Instagram, Twitter, Facebook, Ty and Rye Podcast. Also, check us out at myprosperteam.com. Thanks. We will see you next week.